This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 267, incredibly 267. Today, Ben, you talk about the expected cost of pessimism. Super excited about that topic and what you will talk about. And as people know from our last episode, Mark McGrath has joined our team. And today we're going to kick off a new segment, which we are calling Mark's Minutes. Yes, it's quite creative, but we are open to feedback for topic ideas. But Mark's going to join us every couple of weeks to break down another topic in financial planning. And we will also do a recap of an interview we had a couple of years ago with Dr. Moira Somers, who's a great friend of ours and our team. And for this week's book review, once again, we've been lucky to get the author of a book to join us. We're going to talk about the book called Storyworthy, Engage, Teach, Persuade, and Change Your Life Through the Power of Storytelling. So this book was written by Matthew Dix and Dan Kennedy. So Matthew's going to join us today to talk about the importance of storytelling. And of course, they'll have the Aftershow for the three of us to stick around.
Yeah. I do want to highlight before we get into the episode that we have an upcoming webinar. We've been mentioning these on the podcast, and to our surprise, and maybe it shouldn't be a surprise, I don't know, but to our surprise, a ton of people have heard us talk about the webinars on the podcast and then signed up for them, which is great. That's why we're doing them. I think they're more valuable to everybody if lots of people are attending. But Angelica mentioned to me, I think last time we mentioned one of these on the podcast, 44 people signed up for the webinar. It's like, it shouldn't be a surprise given the number of listeners that we know we have, but it is just amazing to see. Anyway,
and
so we
great.
Do have another. What's that?
The events are great. The way they interact and they use that tool to get interaction, they're very cool events.
Yeah,
it's not just a boring financial seminar.
Yeah, no, they are cool. And I've watched a few of them because we're recording them and posting them on YouTube, and I think the team is doing a really, really good job delivering them, both with their actual delivery, but also with the software tools they're using. It's like you said, Cameron, it's just a cool setup. So the next one is September 6th, and the topic for this one, which I think will probably be pretty popular, is how much do I need to retire? How much money do I need to have saved for retirement? And Phil Briggs and Jordan Carter from our team here are going to be hosting that. So that's September 6th, and you can find the sign up. We'll put it in the show notes, but it's also on our on PWL social platforms.
Yeah, so these events are happening every 2 weeks. So to stay in the loop on what's going on, just follow us on Twitter or on LinkedIn. Everything's posted there.
Yep. Cool. All right. So that's the upcoming webinar. And with that, I think we can go ahead to the episode.
All right, Ben, let's dive in. This is a pretty cool topic, and I think people find it interesting. So kick it off.
I think it's interesting too. I started thinking about this. We mentioned this in our last episode, and I saw some people talking about the comments that I made about this online. After actually I wrote this, what we're going to talk about today, but just kind of suggested to me that it is a pretty interesting topic. But just the comments that I made last time that got me thinking about it were just this idea that there's an inverse relationship between people's subjective return expectations and expected returns. So that's what got me thinking about this. But it's what I've titled the topic is the expected cost of pessimism. I think I think that's pretty catchy. I don't know.
It is when you think about it.
Yeah, I think so. Okay, so if worrying about the next market crash is affecting your investment decisions, you're not alone in that. I think that's something that worries a lot of people and affects the asset allocation decisions of a lot of people. But what I'm going to argue is that you're making an expensive mistake by letting that worry affect your decisions. People spend so much time worrying about the next market downturn that they end up missing out on market returns, which tend to be positive in the long run. And it makes me think of that famous Peter Lynch quote, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Stocks have been this like incredible wealth generating tool around the world for hundreds of years. And I'll talk about some of the data behind that hundreds of years comment, which I think is also pretty cool. But a lot of investors hold pessimistic beliefs about the stock market, and people with more pessimistic beliefs, and there's data on this. There's a paper on this that I'm referencing. Two papers, actually. People with more pessimistic beliefs about the stock market invest less of their wealth in stocks or just don't participate in stocks. So the result is pessimistic investors leaving huge amounts of potential wealth on the table. So that's my expected cost of pessimism idea. Now, if we go back as far as we have data, which, as people may remember from Will Getzman that we had on as a guest a while ago, we have data going back pretty far. But as far back as we do have data, the optimists, the people who have invested in stocks, have triumphed. And of course, there's that famous book by Dimson, Marsh, and Staunton, The Triumph of the Optimists, that kind of touches on that. Now, it is true that some individual stock markets have delivered total losses, and like that's Russia and China being prime examples in history. I'm sure there are others if you go back far enough. And then some markets have just had really poor returns in the long run. But globally, global stock returns have been incredible for at least 123 years, which is where we have the really good quality Dimson, Marsh, Staunton data. But we also have the Scott Cederberg data that goes back a little bit further. And then we have data for the Netherlands and the UK back to 1629. And we have data back to 1372 for one French company. And that's one of the ones that we talked to Will Getzman about. And you take all that together, and it suggests a long-run real return of around 5% for stocks, which is also, I think, what Fama told us.
That's exactly what he said.
Yeah, around 5%. But that number, that roughly 5% in real terms, has been persistent for hundreds of years. 1372. Crazy. Now, to be clear, I'm not saying stocks are risk-free in the long run. They have been and will continue to be volatile in the short run, and they're certainly not risk-free even in the long run. It's possible to lose money in real terms even over a 30-year period, and that's one of the things that we talked to Scott Cederberg about. But especially in a single country, the chances of losing over 30 years in a diversified portfolio are much lower than in a single country portfolio. But even still, there's a non-zero probability using Scott Cederberg's data. But even when you account for failed markets and bad outcomes, long-term diversified investors who have remained disciplined have been typically rewarded quite nicely. Now, so that's the setup. That's the long-term evidence. That's the reason to be optimistic. But despite the long-term evidence supporting stocks as being sensible long-term investments for most investors worry about watching their investments fall in value day to day, even if those day-to-day drops won't affect their long-term plan. And that's myopic loss aversion, which is a term people may have heard about. It's a problem for long-term investors. And there's actually research on this from John List, who we had on Rational Reminder a while ago. He found that people who check their investments more frequently invest less in risky assets and earn lower returns. So individual investors, or part of the problem here is that individual investors tend to believe that the next major market crash is just around the corner. So they're myopically loss averse. They think short term and worry about losses, even if they are long-term investors. They believe that the next major market crash, like the next crash on par with the next one-day crash on par with 1987 or 1929, investors' sort of subjective assessments of the probability of those events is about an order of magnitude larger than the actual historical frequency of those events. So that's kind of crazy.
That's wild.
You combine that with myopic loss aversion, it's not a good setup. Pessimism is also influenced, at least in part, by the media, which has an asymmetric effect on crash beliefs. This is also fascinating. Articles with negative sentiment increase crash beliefs, while those with positive sentiment have no effect.
Wow.
Yeah. And then another important one is that bad stock market outcomes receive disproportionately pessimistic coverage in the media. Now, the impact on investors. So pessimistic beliefs about market crashes, they do affect how people invest. Subjective crash probabilities are negatively associated with flows into equity mutual funds. And the equity share of investors' portfolios is influenced by their perception of rare disaster risk, by the perception of some big bad thing happening in the stock market that will affect them. Now, market crashes are certainly painful, and I don't want to minimize that. But remember, markets have delivered positive long-term returns despite many historical crashes. And when crashes do happen, this is another important point about the pessimism stuff. When crashes do happen, investors' expectations of stock market returns become more pessimistic, which I guess you'd expect based on what we've covered so far. So they become more pessimistic despite the evidence that falling stock prices usually indicate higher expected returns rather than lower,
Right.
and that the probability of a large positive return is higher following a crash.
Right.
Right, so that's that inverse relationship between expected returns and subjective return expectations. And that's kind of how we can generalize those comments, is that investors' subjective expectations, if you ask someone what you think market returns are, what they think market returns are going to be in the next year, a few years or whatever, that number, that expectation is going to be inversely related to actual market expected returns. Expected returns go up, return expectations go down, which is pretty crazy. And I think that point is incredibly important because we see it, right? Like that people get more risk averse and it has to be that way. Expected returns are high because people have become more risk averse.
Right. But it's usually wrapped up in something like, oh, I'll just sit out now. I don't mind missing some of the upside, but I just want to preserve my capital. I'll buy it back in later.
Yeah. Which, hey, sure, but that's one of the likely explanations for why investor returns trail in fund returns. Like if you go and look at the returns of a fund and ask how have the investors in that fund done, they typically underperform by quite a bit, and increasingly so with increasingly volatile funds.
If you think over your investing lifetime, it is very easy to not get what the market has to offer. It's very easy to get it if you stick with it, but there's a lot of chatter, media, friends, nervousness. And I think as the dollars get larger, it gets more difficult to completely ignore all that.
Yep, definitely. Yeah, okay. So people tend to revise their subjective return expectations, their feelings about stock returns, about stock return expectations downward when market expected returns are high, which I think leads to an under-allocation to stocks, arguably at the worst possible times. Now, the fact that expected returns seem to increase when stock prices fall actually makes stocks a little bit less risky in the long run than they would be if they were completely random. That's that return predictability idea, where expected returns rise when markets are volatile. That makes stocks a little bit less risky in the long run than if they were just totally random. Now, another fascinating and important input here in thinking about this is that personal experiences also matter a lot to investors' expectations about the future. Even though, like, again, when you step back and take a sort of cold, rational approach to this topic, personal experience should not have anything to do with an objective assessment of expected returns. But in reality, people who've experienced low stock market returns throughout their lives are less willing to take risk. They allocate less of their wealth to stocks, and they're more pessimistic about future stock returns. And then we mentioned asymmetries in the way that the media affects people's expectations, but there's another one here where there are asymmetries in the way that people learn from new stock market information. So the formation of beliefs when learning from losses tends to be overly pessimistic, overly sensitive to bad outcomes, and further away from an objective assessment of expectations compared to the formation of beliefs when learning from gains. So people learn more intensely, or their expectations are informed more intensely by losses than by gains.
Wow.
Right. Personal experience with investing, it can even affect how much people save for retirement, with those who have earned high risk-adjusted returns increasing their savings rate more than people who have had a less rewarding experience. So it can affect both the asset allocation channel, but also the savings channel. Now it makes sense when you think about it.
Sorry to interrupt, but do you think that's the greed that's kicking in? So if you've had a good experience, you're saying people will be saving more, be more motivated to save more?
Yeah, that was a paper from James Choi. But yeah, they found that people who earned higher risk-adjusted returns increased their savings more. I don't know if I'd call it greed, but like if you've put money into this, I don't know what example to use, but an index. So maybe it's a China index or a Russia index or something like an emerging markets index that's done poorly. If you put money into that, I don't know, 10 years ago, I don't know what the actual returns of those indexes are, but whatever. You take a losing index, you put money into it 10 years ago, and it's been flat or you've lost money. Like, would you increase your savings rate? Probably not. But if you've made a bunch of money, I don't know if it's necessarily greed. It's just learning. Like if you learn that this stock thing kind of sucks, or maybe you're in a mutual fund with 3% fees or something and you've been flat for 10 years, but it's been extremely volatile. You look at that and it's like, well, I'm not going to put more money into that. But meanwhile, if you've made money, I think it just, you learn that it's a positive experience. And I mean, you just think about it. It makes sense. Like if you've lived through low returns, you'll be hesitant to keep saving and investing
in that investment, but you might come back and say, maybe there's a better way to do this. And that's what I'll...
Do people do that though? Do people step back and say...
People are messy. People are messy. We say that all the time.
And they don't know. They don't know that there's been a 5% real return in stock since 1372. Most people don't know that.
No.
I didn't know that until we talked to Will.
Absolutely true.
Yeah. So they don't take that step back and objectively assess their expected returns with data outside of their own personal experience. They just take their personal experience as the right way to form expectations. Anyway, so if we kind of back up and take all that stuff together, I think people tend to be pessimistic in general. They worry about short-term returns, even if they themselves have long horizons. They're influenced by the financial media, which overrepresents negative outcomes. They overestimate the probability of an impending market crash. They become more pessimistic when expected returns are high. They condition their beliefs about the future on their own personal experiences, and they update their beliefs more aggressively following losses than gains. It's like, that's a pretty rough setup, right, for investors. Now, those errors, if we can call them errors, I'll call them errors, lead investors to hold more conservative portfolios than a more optimistic investor would, or to avoid participating in the stock market altogether. But in either case, they're sabotaging their long-term returns with short-term decision-making, which is not ideal. So that's the bad news, I guess. That's the effects that pessimism can have. But I do have some potential solutions or suggestions that I tried to think through. Like, given these problems, what can people do to improve outcomes? I think an easy one, and again, coming from John List, and we talked about this with him when he was on the podcast, is to look at your investments less frequently. Or that's like Cliff Asness always makes this joke about making an illiquid fund that you can't see the returns of for whatever. Can't see the returns for 10 years. You can't actually do that because regulators wouldn't let you. But individuals can choose to look at their investments less frequently. So like we know that people are myopically loss averse. We know empirically that seeing your investments less frequently is associated with earning higher returns and taking more equity risk. So I think that automating or delegating more of your portfolio management process to reduce how frequently you have to interact with your investments may be helpful. For an example there, investors lose less of their returns to inopportune investment timing decisions in asset allocation funds. This is based on Morningstar's data, which rebalance automatically, than they do in, for example, equity funds, and even more so in sector funds. And that's comparing the investor return to the investment return. That gap is smaller for asset allocation funds, which rebalance themselves. That data has its flaws, but my hunch, though, and then there's enough of a trend between asset allocation funds, equity funds, and sector funds, which have a widening gap progressively. But my hunch there is that it's at least partially related to rebalancing after equities drop being really difficult for a lot of people, whereas asset allocation funds are doing it themselves.
Yep.
That's buying stocks when pessimism and expected returns are high and subjective return expectations are low. That's hard. Of course it is. Now, automating your investment process is only helpful if you're investing in stocks to begin with, which a lot of people who are pessimistic about the stock market are just not. That's the the problem of non-participation in stock markets. Financial literacy does seem to increase stock market participation. So I think watching or listening to podcasts like this can be helpful. Tuning out the financial media is another easy win. The media makes investors more pessimistic. And I'm going to make an extreme statement here without offering them any useful information. Now listen to this. There's a paper here in, I think, Journal of Finance, but it's one of the most widely cited papers that I had not heard about previously. Like thousands. Hold on, let me I gotta find the number, because when I saw this, I was like kind of taken aback. 2,439 citations. So this is a big paper. I just hadn't come across it before. But the findings are incredible. So they say by the time the media is reporting on something, or sorry, these are my words, and then I'll use their findings to support it. By the time the media is reporting on something, that thing is already reflected in prices.
Mm-hmm.
Media content does not contain new information about fundamental asset values.
Sells advertising.
Yeah, sells advertising. Anyway, so you're not gaining anything from financial media, but you are getting more pessimistic because the people learn asymmetrically from the media, and the media also disproportionately covers negative events, but you're gaining nothing from it. So cutting that out is a pretty easy win. I think that since many of the issues we've talked about are related to errors in base rates, like we talked about, well, why don't people just look for different investments? And I said, because they don't know that expected returns are positive and that historical returns are positive. Or they don't understand how expected returns change over time. I think those are all base rate issues. So getting an outside perspective might be useful. Financial advisors do seem, and there's how many papers? 4 papers that I have on this, I think.
Yep.
Financial advisors do seem to increase participation in the stock market and to boost the share of stocks in investors' portfolios. And I think that makes sense to the extent that financial advisors' beliefs are more informed than their clients. There are, of course, issues with financial advisors, but on this specific topic of equity participation, they do seem to have a positive effect. Trust in a financial advisor may also reduce the perceived riskiness of investments and allow risk-averse investors to earn higher expected returns with a financial advisor than they would on their own. And that is I think that's a theoretical paper in the Journal of Finance called Money Doctors. His best premise is basically that the prevalence of a financial advisors may be explained by trust allowing investors to earn higher expected returns than they would on their own, because just like due to that trust channel. Empirically longer duration client relationships, which this paper used as a measure of trust, increase clients' willingness to take risk with their investments. Now, it's easy to say that people don't need financial advice because everyone should just go and buy low-cost index funds in their discount brokerage account, which is something that I, of course, agree with, theoretically, but a lot of people don't do that. So anyway, I think that's an interesting solution to non-participation and to unnecessary low stock exposure. Now, while financial advisors may help to get people invested and to get the right amount of stock exposure, I think it is important to watch out for high fees, and conflicts of interest, which could easily, and I have actually seen papers showing that in their sample, that the fees basically offset the benefits of the financial advice. I think it's also important to be wary of the fact that a lot of financial advisors make the same errors that a typical individual investor would. So it's a bit of a minefield, but I think that on this issue of pessimism and non-participation and low equity exposure, financial advisors can help, but caution is warranted, as usual, whenever we talk about that topic. Okay, so to finish, pessimism is expensive, or it's expected to be expensive. It's got a high expected cost, which is basically the expected returns of equities. The stock market is this incredible tool for long-term wealth generation, but to benefit from that, you have to participate in it consistently. Myopic loss aversion, overestimating the probability of crashes, having pessimistic subjective return expectations when expected returns are high, and conditioning expectations about the future on negative personal experiences can all lead to missing out on the returns that the market has to offer. Looking at your investments less frequently, automating or delegating your investment process, increasing your financial literacy, getting an outside perspective, and potentially hiring a skilled financial advisor with a whole bunch of qualifiers with reasonable fees and limited conflicts of interest are all potential solutions to reducing the long-term costs of pessimism.
Brilliant. That was awesome. Lots of references. I love when you take these references and roll it all up into a concise, important lesson.
Yeah, I think there were 31 papers in there, which we'll, of course, link in the show notes.
31 papers into 23 minutes of content. It's wild. Anyway, that was fantastic. Yeah.
Awesome.
Okay, why don't you queue up Mark coming on next?
Yeah, right. So we'll go ahead and I'll introduce Mark when we flip over to that segment. But this is going to be our first Mark's Minute with Mark McGrath. So let's go ahead to that segment. Mark McGrath, welcome back to the Rational Miner podcast to kick off your new segment, which we are very tentatively calling Mark's Minutes, and we are open to suggestions from the audience on what we should call this segment. Maybe they'll get a better feel for it once you've delivered this topic.
Yeah, there you go. Maybe after a few episodes, we'll get some creative input from the audience.
Yeah, so let's go. Let's get right into it to talk about what the topic is, and then let's just go.
Sure. Yeah, sounds good. So this is something I wrote about or tweeted about recently, and I have tweeted about it in the past too. And I know, Ben, you've got a video on this actually as well. But I tweeted recently that you should be hesitant or shouldn't take risky bets with your tax-free savings account, your TFSA. And incidentally, a couple of weeks later, I stumbled upon a post on Reddit, on the Personal Finance Canada subreddit, that sort of exemplified the exact issue that I was talking about. So I think first I'll give a little bit of a preamble or background on the TFSA, how it works, how the contribution works, some of the benefits of the TFSA. We'll get into the problem, and then we'll talk specifically about this particular case. So for listeners who are not aware, the TFSA came to fruition in 2009. And the way it works is you get a set amount of contribution room each year. Everybody who is of age of majority, gets the same amount of room. And it's based on basically from 2009 forward. If you were at least 18 years old, you qualified at that time. So for 2023, the contribution room is $6,500. And if you go back and you were 18, at least in 2009, your cumulative room as of this year would be $88,000. Okay. So if you've never used a TFSA before, you can dump $88,000 into it today, right? Now, there is another sort of calculation that comes into place when looking at TFSA room, and that is that any withdrawals that you made from a TFSA in previous years can be recontributed the following calendar year or later, right? So quick example, you open a TFSA today, you put in $10,000, you invest that money, it grows to say $12,000, you withdraw $12,000. The following year, your contribution room is going to be any room that you haven't used from the current year and previous years, plus the full amount of that withdrawal. So plus the full $12,000 in that scenario, right? So that's how the contribution room is calculated. The benefits of the TFSA, of course, are that any investment income or investment growth that you earn in the TFSA is tax-free forever, whether you withdraw it from the TFSA or leave it in there. So if you've got a, just call it a globally diversified portfolio, and it's, spitting out interest in Canadian dividends, foreign dividends, some unrealized capital gains, none of that is taxable to you in theory, right? So over long periods of time, the TFSA is an incredibly powerful tool when used appropriately. And so here comes the problem. So people tend to focus on the upside returns that are possible with the TFSA, and rightfully so, right? We, generally focus on the benefits of the TFSA, but it's a two-sided coin. And so the issue is that when you lose money in your TFSA, if you make an investment in the TFSA and it drops in value, so take the same example, you invest $10,000, but it drops to $7,000 and doesn't recover, you're a bit hamstrung because you've lost that $3,000 of contribution room now. Even if you withdraw the $7,000, again, the following year, you can only recontribute what you withdrew from the TFSA. So the following year, you only get back $7,000 in room. So you've permanently impaired your TFSA room when that happens, right? and I've even had accountants tell me, like TFSAs are for trying to hit home runs and this type of thing, but rarely do we think about the downside implications of using the TFSA in that way. So in this particular case, in this Reddit post, this investor was 31 years old, and he had about $70,000 in his tax-free savings account. He put it all into one stock, and this was a pharmaceutical company or a biotech company, I believe it was. It actually wasn't a penny stock at the time. I looked at the chart last night, and it's been listed since 2009, and as recently as 2018, it was trading at over $90 per share Canadian. So it wasn't, on the surface, it didn't look like a super high risk stock or a penny stock or anything like that. And what this investor did is he continued to buy as the stock dropped. Now, I don't know exactly how much contribution room he used up. He just mentioned that he had $70,000 in his TFSA. So I don't know if he, put in 50 and it grew to 70, but I think that's besides the point, because the lesson still stands that he bought it all the way down. And as of May of this year, the company was delisted from the NASDAQ. Basically, for all intents and purposes, it went to zero. And so the outcome here is that not only has this investor lost $70,000, which obviously is not good, but he's also burned $70,000 worth of his tax-free savings account room that he can never recover. This stock is never going to recover. It was delisted. It's gone to zero effectively. So he's now lost all of his contribution room, or at least, the $70,000 that he had in room. And then lastly, of course, because it's a tax-free savings account and all of the investment income and growth is tax-free, when you have losses in your TFSA, you can't claim a capital loss for tax purposes. If this was in a non-registered investment account, which is just an account that's outside of a TFSA or an RSP, he would have had a $70,000 capital loss. And if he did, he could have carried that loss back up to 3 years and refiled tax returns, or he could have carried it forward indefinitely to offset future gains, right? So it's a bit of a triple whammy. He's lost the money, he's burned the TFSA room, and he gets no tax benefit for the capital loss, right? So if you think about it, that 70,000, just napkin math, at a call it a 3% real rate of return or something like that, you're looking at $190,000 or $200,000 of value that he could have accumulated by just investing more rationally. So that's it for today, and that's why you don't make risky bets rather in your TFSA.
I love it. I looked at this pretty recently because I was actually thinking about. I saw that same Reddit post that you saw, and I was thinking about refreshing my video on this because I did that one like years ago. I sent it to you and you said, what did you say to me? That you mean this in a nice way, but my videos have gotten a lot better since. Yeah, my old videos were terrible. But yeah, I was looking at the numbers on this and the difference in after-tax growth, like if you assume that you just invested in a diversified portfolio at a high tax rate in a taxable account versus a TFSA, that long-term difference over like 30 years is massive. Like you could have 2x the wealth by being in a TFSA in a tax-free savings account than by being in a taxable account. So that the cost of losing that room is really high. So you're not getting the capital loss, which is terrible, but then not having that room as a long-term investor is like real bad.
Yeah, huge.
So your point is even more powerful, Mark, if someone has other assets outside of the TFSA. But if someone only has a TFSA and they have a lottery-like personality, I guess that's the only argument to go for something like this. But if you have a diversified portfolio outside, it doesn't make any sense at all.
Mm-hmm. And in this case, the poster, the investor did say that this was virtually all of their savings. So they've reset themselves essentially.
So they rolled the dice and came up short.
Well, you got to think that so in the TFSA, you are taking more risk because in the taxable account, the government's sharing in some of your upside, but they're also sharing in the downside. Yeah. But in the TFSA, you're taking more risk. So like if you really, really want to take a lot of risk, the TFSA is, I guess, arguably a good place to do that. However, if you look at the statistics on individual stock picks, you're much more likely. It's like playing the lottery, literally. There's this massively skewed distribution. Anyway, I think it's such an important point. I'm glad you brought that to us, Mark. It's a good one.
Yeah, no worries. Thanks.
It's a great kickoff to Mark's Minutes. Awesome to have Mark join us like that. It's going to be so great to have him on a regular basis, which is pretty cool. Such a good guy. Such a great addition to an already incredible team. So let's dive into another look back at a previous episode that we found interesting. So I'm going to jump right into it this week with our good friend. So in episode 45, back in May of 2019, we welcomed Dr. Moira Somers to the podcast. Moira is a psychologist, a family wealth consultant, and the author of the wonderful book, Advice That Sticks, How to Give Financial Advice That People Will Follow. She's been a coach to our team for a long time, and it's helped many of our clients over the years. In our conversation with Dr. Somers, we discussed how a wealth psychologist can help someone's situation. And this help is as much for advisors as it is for investors they are advising. Advisors need to be as effective as they can be in helping people make financial decisions. And since all decisions have an emotional component to them, it is important to be as aware as possible of what the client's true motivation is and also the emotional state of what the advisor is in while the decisions are being made. That is the key takeaway, in my opinion, of that conversation. We discussed what it takes to be a successful DIY investor and the value that a great advisor can bring when they bring their most aware self to helping clients. Make sure you listen to the end where Dr. Somers describes how money, time, and energy form an important trifecta and what we have to work with in our lives. That was episode 45 with Dr. Moira Somers.
Very nice.
She's fantastic. She's a fantastic person and a great friend of all of ours here. So great episode. Okay, let's jump into the book review this week. As we've done recently, instead of doing an actual review, I don't think I've done a review in a long time, actually, without having a guest on. But recently, but maybe I'm just more attuned to it because I hear about it quite a bit. For example, on the Prof G podcast, Scott Galloway is always talking about storytelling being one of the key skills he wants his two boys to develop through their education. So in an effort to learn more about storytelling and to develop my own skill at it, I looked for a book that explains why stories are important, what impact can they have, but also how can you get better at practicing storytelling. So someone recommended the book Storyworthy, Engage, Teach, Persuade, and Change Your Life Through the Power of Storytelling by Matthew Dix. And with a title like that, you can kind of tell it's probably a pretty important topic. I know, Ben, you've got your own personal reservations are strong about storytelling, but I don't think you can debate the impact that storytelling can have on others.
I don't have enough information to debate it. I just know that personally, when I'm reading a book that has, a combination of data and stories, I find myself flipping past the stories to look for the data.
So what they're referring to in the book is these short stories. We're not talking about long. Like, I agree with you. When reading books, that kind of drives me nuts as well. This is using storytelling just in communicating with others, be it at work or at play. So anyways, Matthew Dix is an elementary school teacher, columnist, and internationally best-selling author, including several novels, in addition to his nonfiction titles. He's a record 59-time Moth Story Slam and 9-time Grand Slam champion who has performed for audiences around the world. So these are much like stand-up comedy clubs, except it's people getting up and telling their stories. They also have a podcast, which is kind of fun to listen to, some crazy stories. You can tell these people who are good at telling stories are fascinating to listen to. He's also the founder and artistic director of Speak Up, which is a Hartford-based storytelling organization. He teaches public speaking, storytelling, and marketing strategies to corporations, universities, politicians, advertising agency, the clergy, and many more. In the book, he wrote, "Make it your mission to find, see, remember, and identify stories. You'll begin to see your life in a new and more compelling light." So I thought it'd be cool to have him on. He talks about having a daily practice of try to find a story a day. Like he says, take a few minutes every morning and just try to find a story. So I did that for, a few weeks. I must confess, with vacation, it kind of fell off. But it's interesting to look for stories that have impact, and it's often not something big that happened in the day. It's when you just like conversation with a client, for example, something will come out, they'll refer to something just because it's a great story.
Can you give me an example? Like you said, you were coming up with a story a day for a while. What
So one example, I had lunch with a longtime, very dear client earlier this summer who had a knee replacement, and I don't remember I actually wrote the story out, so had I known you were going to ask me this, I would have been more prepared, but I remember being aware of looking for a story. And he talked about the relationship that we have had for probably 25 plus years of going for lunch every quarter or so. And he says, when I string that relationship through all these years together, I just have so much appreciation. And he says, remember that sketch we drew out this has to be 20 years ago, of what my financial plan was, where we have my pension from here, my savings from here, my Canada pension plan, my inheritance from my mother, my business assets. And you kind of drew my picture of my life. He says, I have that picture. And he didn't have it with him. He said, I've got that blaze in my brain. I said, well, we have it in our hard drive back at the office, and I know exactly what you're talking about. He said, that's been my guiding light for 25 plus years. So he says, combination of that along with our complete trust relationship. I'm like, wow, there's something really interesting. Like, I didn't work on it to hone it to go and try to present it at a slam event, for example, but it's something where you notice it. And I think it just becomes an interesting story. I don't know what you do with it, but it's just like a little thing that happens that illustrates the trust we develop, how you might, craft a financial plan for someone, just the concept of the plan. And it's been successful for him, and he successfully retired. Those are all over the place in your daily life. Anyway, so with that, let's welcome Matthew Dix, the Rational Minder podcast, and go to our conversation with Matthew. Matthew Dix, welcome to the Rational Minder podcast.
Thank you so much. I'm thrilled to be here.
Well, it's great to have you, and I loved your book, Storytelling. I thought it was just a wonderful book and tool to learn how to do storytelling.
Thank you. Thanks so much.
So how important is storytelling?
Well, I mean, Steve Jobs said storytellers are the ones who rule the world, and I tend to agree with him. It's amazing how you can reshape reality to the way you need it to be if you know how to tell a good story. So I think if you want to communicate with people, especially to be memorable and to be someone who people actually want to listen to be entertaining, I think so often people have important and meaningful things to share, but they make no attempt to share those things in a way that capture the attention of an audience. So when you're a storyteller, you can say those important things and have people hear you, and you can even say unimportant things that sound important because you're able to tell them in an effective way. So I think it's huge. I think it's so important.
Can you talk about some of the contexts where storytelling is useful, like at work or in your personal life?
Well, just about everywhere. All I have to do is look at my client list. Just this week, just an hour ago, I was working with an attorney, and an hour before that, I was working with a priest. And, I've been telling stories all my life to my children. It's the way I got my wife. If you ask her how she fell for me, I had hoped she would have said, I took one look at you, but it turned out that was not the case. It was through storytelling that I managed to get my wife. I'm a terrible, terrible golfer, and I play all the time because people know that while we're looking for my ball somewhere in the trees, I'm going to entertain them with a good story. So whether it's business or whether it's personal, I work with scientists. That's really helpful. People who do important research, but sort of don't understand how to communicate that research in a way that convinces people that what they're doing is worthy and important. So I have yet to find a business or an industry or a person for whom storytelling can't help them significantly.
Wow.
What makes a great story?
Well, you have to know what a story is. And that's really the troublesome part for most people. Most people think of storytelling as something happened to me over the course of a period of time, and I'm going to tell you what that thing was. That's often reporting on your life, but not actually a story. And the only people who want to hear you report on your life is your spouse, maybe your mother, possibly, and that's about it. Nobody really wants to hear a report on what your day was like. A story is about fundamentally change over time. It's either realization, which is the most common one. I used to think something and then some stuff happened and now I think a new thing, or I see the world in a new way. Or sometimes transformation, which is I used to be one kind of a person and then some stuff happened to me and now I'm a new kind of person. That's every movie you've seen, every book you've read. And it should be every story that you tell. That isn't to say that you can't tell a funny anecdote. You can't tell someone the funny thing your kid said or the thing you saw the other day. All of those are fine, but they don't qualify as stories, meaning people won't remember them. They're not going to convince people. They're not going to change their minds. They're not going to let you worm your way into their hearts and minds. So when you want to tell a story, it has to be over the course of a period of time, whether that's 1 minute or 100 years, I changed in some way, and now I'm going to share that change with you.
How big is a great story?
Well, that doesn't have to be big at all. I am very famous for taking tiny little moments and making them into stories. I have a friend who says, Matt can pick up a pebble And somehow he will turn that into a meaningful story that will make you laugh and cry by the time the pebble has sort of ascended to his eye level. Now, that's not true. That's an exaggeration. But, I'm a person who got into storytelling originally because I've had a bunch of big, ridiculous things happen to me. I've died twice and come back to life through CPR. I've been arrested and tried for a crime I didn't commit. I was homeless and in jail, all of those things. But I quickly discovered as I was telling stories that those are not the most interesting stories to tell because it's really hard for people to relate to jail and to homelessness and to your heart stopping beating and you stop breathing. All of those things are difficult to convey. It's much easier for me to tell a story about a moment I have with my son or a moment with a friend or little tiny things. And so what I've become known for sort of in the storytelling community is stories that where nothing basically happens and yet so much happens over the course of the telling of the story. The mistake people make is they often think that stories are the action that's happening around us, when most of the time, most of the changes that occur in us, they happen in an invisible way. Like if you're watching me at the moment I suddenly see the world in a new way, I'm not going to have any physical manifestation of that moment. So most of the time, stories, those significant, meaningful moments, they happen in our heads and no one would ever know they're happening. So the storyteller has to convey that all of that emotion and all of that reality to the audience in a meaningful way. So stories can be infinitesimally small. Now, naturally, they can be big. I have told stories about the times I've died and come back to life. You can't avoid those. Those are little gems that are harder to tell, but when you tell them well, they're great too. But you don't need much to tell a story.
How do you find great stories?
Well, I have a bunch of strategies. The one that I use the most is called homework for life. And I have a TED talk on it. So if someone wants to go into real great detail, they can go just Google the phrase homework for life and they can find it right away. But essentially, what I tell people is that we have stories in our everyday lives that we miss all the time. We ignore them, or when we see them, we take note of them and then we throw them away like they're trash. The worst game I play with people is I say, take your age, whatever it is. I'm 52. And today we can subtract 12, let's say. So if you subtract 12 from your age, for me, it's 40, whatever your numbers are, think about that year of your life and tell me how many stories you can remember from that year of your life. Now, unless you moved or changed jobs, got divorced, got married, had a kid, unless you had one of those big moments, a lot of times people can't tell me a single thing from a year that happened just 12 years ago. I've actually had people cry in workshops when they realize they've lost an entire year. It doesn't mean that nothing happened over the course of that year. It doesn't mean that they don't have a life filled with stories. It really just means they walked through life and left all of those stories behind. And so homework for life is a process where every single day I basically reflect upon my day and look for the stories in that day that I might tell. And not every day contains a story, but more days contain stories than you might expect. And through the process of doing this every single day, sitting down and saying, what is my story-worthy moment? And I write it down in a very short way using Excel, just a tiny little bit, just enough to hold on to the moment and the memory over the course of time. And it's not just me, thousands and thousands of people around the world will report to you that over the course of time, if you do this, you'll start to see stories that you're not seeing right now, and you'll hold on to the ones that you're lucky enough to see. So there's lots of ways to find stories, including mining your past. That's very useful too. There's lots of strategies you can use to do that as well. But just by paying attention to the everyday life you're living and those moments where your heart lifts and soars or falls, or you see the world differently, or someone says something to you that makes you think about yourself or your job or your spouse differently. All of those are the moments that we're trying to tell as storytellers.
How do you craft a story that will connect with the audience?
Well, the joy is if you're telling a story about change over time, a meaningful and rich story, it's going to connect. The best example I have just happened to be on a plane yesterday. I was flying home from Washington to Connecticut across the country, and I decided to watch the movie A Few Good Men, which is a movie I've seen a million times. And I had just been reading about it, and I said, well, I'll watch this and analyze it while I do some other things on the plane. And as the movie ended, I found myself crying on the airplane. And I had never cried over this movie, and most people, frankly, don't. There's not a lot to cry over. But as I watched it this time, it's a movie about a guy named Daniel Kaffee, and his father has passed away, and he's living his entire life trying to impress a father who is no longer on this earth. And at the end, he wins the case, and he finally feels like he has done enough to sort of earn his father's love, even though his father is no longer with us. You know, my father left me when I was 7 and never really came back. And somehow, because Aaron Sorkin was smart enough to not just put a lawyer in the story, but to put a lawyer who is trying to overcome the loss of a father and find a way to sort of live up to what his father expected of him, because that was part of the story. It wasn't just a case. It wasn't just a courtroom drama. It was real characters who were overcoming change over time. It made me cry because it made me think of my father and how I can't win the respect of my father because he never came home. Right. And so we tell stories that connect with people when we include character change over time, our own personal change. Because if I tell you that, you know, there was a day when I didn't understand my autistic daughter, and then there was a day when I finally understood her. You don't have to have an autistic daughter to understand. There was once a time in my life where I didn't understand someone, and then I did understand someone. So when we're talking about human emotions and change and the general feelings that people have, the actual context of the moment is not as important. The reality of those moments, as long as we put in the humanity that goes along with it, which is what Aaron Sorkin did really cleverly there. And that's why I found myself crying on a full airplane somewhere over Nevada.
Oh. What's the best way to tell a story?
Well, you know, there's a lot of ways to do it. I always say that when I'm telling a story, what you have to understand is that you're in a conversation with your audience, which is to say you have to understand what your audience wants and needs. So if I'm standing on a stage in front of 1,000 people, what I know is that my audience has their complete attention upon me, which means I can speak slowly and I can use pausing and I can alter my volume and all of those things, because that's a performance situation. And when I tell that story, that's what's expected. I can tell that very same story, though, on a golf course with my buddies. And I understand that they don't want to hear me speak for 8 consecutive minutes while they're playing golf. That would make them crazy. So I have a choice then of either abbreviating the story, or more likely, I'll tell them a little bit of the story here. And then when we get to the green, I'll tell them sort of scene 2. And then, you know, a hole later, I'll give them another scene from the story. And so I'll spread that story out over time. So what we have to think about is not what the story is, but what our audience wants from us while we're telling the story. The mistake storytellers make is they often tell a story in the way they want to tell it, meaning they see the story as something that they own and they need to pass on to an audience, when really what it is they have a story, but they have to find the right version of that story depending on the context they're inhabiting. So if I'm telling a story to my 5th graders, it's going to be entirely different than the story I might tell on a stage versus a story I'll tell to my wife in the car. It's going to be the same story, but the version of it has to change, meaning the length, the pausing, the timing, all of those things, depending on what my audience wants. We have to really think about, what does the audience want from the story, not what do I want from the story.
So this podcast is about sensible investing and financial decision making. A big portion of that is something that we talk about often, is using low cost index funds to invest in the financial markets. How would you use storytelling to get that message across to people, just as an example?
So low cost index funds. So basically what you're telling people is, let's not look for specific stocks. Let's invest in a conglomerate of stocks, and let's make sure we're not paying a lot for that. Is that where that's what we're essentially talking about?
Beautiful. Yep.
So I would be looking for a metaphor where I could describe something like that. So, you know, maybe a good metaphor would be something like this. Actually, this is a true story. So maybe true stories are always better than any other story. My wife doesn't trust me to go to the grocery store and pick out fruits and vegetables. I've never picked an avocado to her satisfaction anytime in my entire life. Every avocado I pick is either overripe or it will, for some reason, never be ripe. And every berry I pick is the wrong shape. And she once sent me to pick up a mango, and I came home with a fruit that we couldn't identify until we put it on the internet and found out it was a papaya, right? So I can't be trusted to go and purchase fruits and vegetables for myself and for my family. So what we've done instead is we go to a farmer's market and we buy a basket full of fruit picked for us from the farmer. So it's fruits and vegetables in a wooden basket that I bring home every week, which is guaranteed to make my wife and my family happy. So, like the stock investor who might go out into the world and say, I'm going to pick this stock and this stock and this stock, probably not a good idea, because unless you're willing to invest enormous amounts of time studying each one of those three companies, time that frankly you'll never have, why not instead invest in a basket, right? A basket that is chosen by experts, a farmer's market, which is a low cost situation. Bring that home and it's probably going to pay off in the long run. Now, that is my first take. But what I did was essentially I tried to create a metaphor, meaning I took what you had and I applied it to my own life. And I simply asked myself, what's an example of a time in my life when I should not be picking out individual things, but instead should be trusting other people to pick those things for me? Did that work?
That was incredible that you just came up with that on the spot. Yes, that worked. That was great.
Part of it is homework for life, honestly, because I have those moments in my homework for life, those moments where I've screwed up the avocado a million times, and because I know it, because I'm noting it every day, I've got that story in my head. And so for me, there's companies actually that I work with that they call me Metaphor Man, which is, Matt, we have a platform on the internet that people use to communicate with other people. It's Slack. I work with Slack, and they say, we're adding a new feature to our platform and we need to come up with a metaphor for it. And you're the one who comes up with our metaphors. Really, all it is I'm just a storyteller that's paying attention to his life. And my metaphors that I offer them are really just my personal stories. And we just take me out of the story and we still have the metaphor that can be used. So you could take the story of my wife and the avocados and all of that out, and you could just say it's like going to a farmer's market. I think it's more interesting if you can actually say something that is personal and meaningful. I think that's even better. But even if you don't, just that metaphor probably works really well in the circumstance too. But I could probably do 3 more right now for you if you really wanted me to, and they would all probably work just as well.
So
yeah, that's very, very cool.
This was my biggest takeaway from your book, is that habit, the daily habit of looking for the story. And as you pointed out in the book, you build this string of them through time that ends up becoming kind of a story of your life, but it becomes this fertile ground to go and look for metaphors in your daily life, because it's so full of these. And it's not my son flipped on his bike and went to the ER. It's not these big dramatic moments necessarily. They're just all over the place once you become tuned to this. So I've been trying to build this habit.
Well, I work with data companies. I actually work with a company that does nothing but helps other companies monetize their data. And so the argument I make with all of these people I work with is, the best data you have is the data that you're collecting every single day over the course of your life, the experiences you're having. And yet, for some reason, business people are likely to throw that data away and seeing it as meaningless, right? That their most relevant, meaningful, everlasting source of data, which is themselves, they don't see that as important. And instead, they gather all of that other data and see that as the value. And I just say, don't throw away what you already have, because it's so easy to walk into a business situation, be asked a question, and for me, respond with a story. And when you respond with a story, you become memorable, you become entertaining, you're able to capture the room. So many people I work with say, I'm at a conference and I can't sort of get everyone to listen to me. And through a few simple strategies, I teach them how to indicate to people that you're telling a story. And as soon as you indicate that you're telling a story, it's like the lights going down in a movie theater. Everyone shuts the hell up. But unless you actually have that story to tell, then you can't indicate that you're telling a story, because you have no content, you have no data. So start gathering your data. And then you'll be able to do what I just did, which is simply come up with a story or a metaphor to apply to almost every circumstance.
Incredible. It was so great to have you on, Matthew. Thanks so much for your contribution. Just incredible.
I'm really glad. I hope it's helpful. I think it's, the beauty of it is I just think that I trick people. What I do is I tell people I trick the business people I work with, corporate America. I trick them into coming into their offices and teaching them how to tell stories for their business. But my secret goal is to get them to just learn how to tell stories for themselves. Because I think the first and most important audience for every story you ever tell is yourself. And the quicker you become a personal storyteller of your own stories, the more likely you're going to be an effective storyteller for the business that you're doing. So don't discard that in any way. Tell personal stories in highly effective ways. And before you know it, you'll be doing the same in the business that you're doing.
All right, let's get into the after show for the 3 dedicated listeners that are remaining.
Yeah, it's great to have Matthew on. I find that stuff so fascinating. No reviews lately, Ben.
Yeah, that's a great point. We would love some more. I always like receiving them, and it's always fun to read them too. So if you're listening and have not yet left a review for our podcast, we would appreciate it if you did so.
Last call for our 2 upcoming meetups. If you're going to be at the Future Proof conference in a couple of weeks in California, Angelica, Ben, and I will be there. We'll also be hosting a breakfast on Monday morning. If you want to join us, email info@rationalreminder.ca. We actually have some listeners. We were going to host as Canadian advisors, but we said, the more the merrier. So a bunch of different people are coming out. We'll also be recording a live episode on Tuesday morning at Future Proof from 9:55 to 9:40 on the social audio experiment stage. We'll be speaking with special guest and good friend of ours, Professor Hal Hirschfield. It's going to be so cool.
I think it'll be cool.
It'll be super fun. I've also heard from a number of listeners who said that they'll be there, advisors that have reached out. Colin from Florida, Corey from Wisconsin, and Emily from Charlotte will also be there. And then the week after that, we're in Toronto on September 21st. You and I will be at the CFA Society Toronto's 2023 Annual Wealth Conference. Going to be having an interesting conversation about some of the history of us and how we came together, and that'll be fun as well. Live audience, live recording.
Yeah, it's going to be interesting.
So it's called Lessons Learned from 5 Years of the Rational Reminder podcast. And then that night, so the night of the 21st of September, that's a Thursday night, we're hosting a meetup downtown Toronto at 5 o'clock. Again, email info@rationalreminder.ca. I think we have 15 people going so far.
Cool. And then I'm going to Edmonton after that. That's the 21st. The 22nd is Friday. I'm flying to Edmonton for the IAFP conference, the Institute of Advanced Financial Planners. And Braden from our team at PWL is speaking at that conference, so I'm going to go and see him speak. But I'm not organizing a meetup because I don't like organizing meetups. But I will be there if anybody is in Edmonton and wants to hang out. Happy to do that.
Awesome. Yeah, I go from there to Salt Lake. I'm going to the Admired Leadership Conference, which will be super interesting with Randall Stutman's company. People may have heard of him. He's been on with Ted Seides as well as Shane Parrish. In the store, we're almost out of stock of Talking Sense cards. There's only 13 left. And I think we've mentioned this before, but we're almost out of hoodies. And the hoodie manufacturer is not available anymore. So Angelica's looking for a new hoodie supplier. So if anyone has a good hoodie supplier of comfortable yet affordable hoodies, like there's lots of nice hoodies, but they get pretty expensive. So today, Ben, it's the first day of us living in the condo while some renovations happen at home.
Oh, wow.
Yeah, that's why I'm in the office today. Yeah, we moved in yesterday, so we had to empty we're doing some renos at home. It's time. So that means that all the furniture on the ground floor has got to go out, and we got to go out. So we're going to be living the condo life just outside of downtown Ottawa, which is going to be so much fun. I'm going to bike to work in the office.
Okay, so you'll be recording
nearby.
You'll be recording from the office for a bit?
Yeah. So we're saying to Mark before we started recording that he's never seen my wall. He's never been in our office before. So got this hand-painted mural here. So maybe I'll put a picture of the wall in the show notes in case people are interested.
Yeah, the wall's pretty cool.
What's up with you lately? Anything exciting other than getting excited for all your travel plans?
Yeah. Well, I'm not doing that again. I'll tell you that right now. I'm going to take a year off of traveling. I'm going to go back to the COVID lifestyle in 2024. Yeah, nothing too crazy. Been riding my bike a lot, which is great. I love living in a place that is easily accessible. Like I can ride out of my house and go onto the trails, which is just incredible.
Wow. Where you live is incredible.
Yeah, so that's been good. Yeah, nothing else too exciting. I've been trying to get the Common Sense Investing YouTube channel, or whatever. We're gonna think of a new name for it. But my YouTube channel where I post solo videos, trying to revive that. So I've got two recorded. One of them is on what we covered in the podcast today, and then another one on actually on last week's Rash Reminder, or the last us episode Rash Reminder topic on holding cash. And I've got another one coming on investing in the AI revolution. But anyway, trying to get rolling back with a regular cadence over there.
It's terrific. Speaking of incredible, we spent a couple days out west. Canmore is unbelievable. Had a chance to meet up with our colleague Travis and where he lives, right by the Three Sisters Mountains. Wow, what a lifestyle. Hiking, biking, fishing, skiing, walking. It is, I mean, I've been out west a number of times. For those who haven't been to the Rockies, you gotta go. Incredible. All right, you good to go, Ben?
I'm good to go.
All right. Thanks everybody for listening this week.